hosted by ICICI Securities Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Ms. Ruchi Mukhija from ICICI Securities Limited. Thank you, and over to you.
Ruchi,
Ruchi, please go ahead.
Am I audible?
Yes, you're audible.
Yes, you're audible.
Good morning, ladies and gentlemen. Thank you for joining us today on Q4FY25 earnings call of IKS Health. On behalf of ICICI Securities, I would like to thank management of IKS Health for giving us opportunity to host this call. Today we have with us Mr. Sachin Gupta, founder and CEO, and Ms. Nithya Subramaniam, CFO, and Mr. Saransh Mundra, AVP Investor Relations. I'll turn over to Saransh for safe harbor and to take the proceedings forward. Thank you, and over to you, Saransh.
Hi everyone. Welcome to our second earnings call as a public company. So I'd like to begin with a safe harbor statement before I hand over to Sachin and Nithya for the remarks. As part of the prepared statements and during Q&A, we may make certain statements which are forward-looking and may involve significant uncertainty. We don't take any responsibility to update such forward-looking statements, and your discretion is advised while making any investment decisions. Over to you, Sachin.
Hi, thank you, Saransh. Good morning, good evening, everyone, depending on where you are. Excited to discuss our performance for Q4 fiscal 25 as well as the full year fiscal 25. On today's call, I have with me, of course, in addition to Saransh, who leads Investor Relations, Nithya Subramaniam, to get the name right, our CFO. And I will kick it off with some remarks that I have on the overall health of the business and the performance at a high level, the financial performance. And then I will invite Nithya to dive into the financial performance in a little bit more detail, after which we will open it up for some questions. So with that, I wanted to start off again, at the risk of a little bit of repetition, with a recap of our business. It's only our second earnings call. Some of you might still be new shareholders. So I'll just give a quick recap of the business and our strategy, and then talk to how we're executing on that strategy and the resulting financial performance from that strategy. So and given obviously we're a niche business, I think that'll be best for everyone. So just so you know, we're operating in the U.S. healthcare provider market, and specifically, given its cost, quality, and access challenges, one of the things that is happening is this transformation from reactive hospital-centric medicine to physician-led, patient-centric, and proactive medicine. And so we believe that the physician setting becomes a new fulcrum of care delivery as a result of that. That physician setting in the U.S., as you will remember, is about a $1.5 trillion market, and that has undergone a tremendous amount of consolidation over the years, and hence it has created this enterprise-scale market segment that IKS operates in. Our fundamental thesis is that when a cottage industry like the original physician market was, very highly fragmented in the U.S., with 900,000 physicians, most of which existed in groups of 5 or less, when a market like that consolidates into enterprise scale and it needs to become the new fulcrum of care delivery, they go through some fundamental transformations. And one such transformation is what we call this transformation from where they rediscover their core versus chore equation within their task continuum. And the smart enterprises figure out that they should focus all their energies on the few core tasks where they create the most differentiated value. And then a lot of the chores that are important to run the business, but might not be where they create differentiated value, typically get delegated to some platform or entity that can do these chores better, cheaper, faster at scale. Now, obviously, given the size of the US healthcare market and specifically the physician market itself being 1.5 trillion, the chores that we have identified, which cut across the entire spectrum from the exam room where the physician sees the patient all the way through the back office, those chores are almost 15%, the cost are almost 15% of their revenue, which makes for about a $225 billion TAM just for the chores that we have identified. And, what we saw over the last 15 years with the business is that this phenomenon of consolidation and hence the delegation of chores really started to pay out. And hence, about 35 billion of that 225 billion has already been delegated. And so this $225 billion odd TAM is actually growing at nearly 8%, but the outsourced TAM, which is around 35 billion right now, is growing at 12%. And that's really that outsourced TAM, or the concentrated or the consolidated segment of that outsourced TAM, is really what we are addressing. One other point, obviously, to remember is our right to win, right? Now, in a market which is as large as $225 billion growing at 8% or 34 billion growing at 12%, in because they want to share of that pie. Now, what happened though, unfortunately, is because the size of the TAM is so large, a lot of players that have come in are really point solution vendors, as I call them. So they've decided to focus on one or two, or maybe in some cases 4 or 5 of these chores. And our thinking was that as the market matures, buyers will realize that they can't be in the business of buying 10, 12, 14 point solutions, integrating them. And so our vision was we will create a platform that has the full breadth of these 16 odd chores. And eventually, buying behavior will graduate more and more to that platform buying behavior. And so, having said that, because that buying behavior is a sort of graduation curve, today we have to live in the duality of certain buyers that still are buying more point solutions, and then early innovators that are starting to demonstrate the platform buying behavior. And that becomes a very important strategic execution predicament for us. Just in a couple of minutes, I'll lay out 5 key strategic execution pillars for ourselves. One of those pillars, as a result of this dynamic of buying behavior, where some are buying point solutions and expanding, whereas others are now starting to buy platform, we have to execute in a way where we are leaders in each of the features of the platform, so we can win in the point solution buying behavior, as well as we are, of course, the only company in the world perhaps today that has the full breadth of the platform. If you can go back to the previous slide, Saraj. That's a high-level overview of the marketplace. Let me now talk a little bit about the 5 key strategic pillars with which we are executing in this business, right? And so the first and foremost pillar is that we are moving to an AI-led, AI-native manifest of this platform. And so, I've always spoken in the past about we started in a human-led tech-in-the-loop model, and we've gone from human-led tech-in-the-loop now starting to go to tech-led human-in-the-loop. But with the pragmatic use of Gen AI, we now have another set of evolution happening rapidly, which is going from tech-led and human-in-the-loop to fully autonomous technology for certain features. So that's going from human-led tech-in-the-loop, in some cases to tech-led human-in-the-loop, but in many cases to fully autonomous Gen AI-enabled execution of features is one of the most important strategic execution pillars for our strategy going forward. That's number 1. Number 2, as many of you will remember, we acquired a significant sized business called Acuity in the 3rd quarter of FY24. And when we acquired Acuity, we had to execute on that acquisition in 4 key dimensions. One, of course, given the size of their business, which is almost similar to our business at that time, we had to integrate this into one core organization that came across as a platform in the market. So that, I'm happy to note, we executed really well on that, mostly through FY25. That was one of the big focus areas of FY25. The second piece was, as you remember, Acuity was a very human-led, US-based headcount execution model, and hence it presented a huge margin optimization opportunity. And one of our key vectors of execution within the Acuity acquisition was getting their margin. If you remember, our pro forma margins in FY24 when we acquired Acuity had gone to about 24%. And the idea was that as we transform Acuity's operating model, we'll be able to get our blended margins to the early 30s over a period of time. So that was something that we would execute on through most of FY25 and then, of course, some going into FY26 as well. The third key vector was that Acuity's 450 plus large enterprise scale clients. There was a big opportunity to cross-sell the various features of the IKS platform into the Acuity install base. Remember, we had 16 features in our platform. Acuity barely had about 3. So created a whole cross-sell opportunity. But that obviously, that execution had to be started in late FY25 and really will start manifesting most of FY26 onwards. And then last but not the least, another important vector was in addition to 450 clients that Acuity had, they had another nearly 250 clients that were not those consolidators, enterprise scale clients. And as you know, the cost of servicing small clients and is almost as much as servicing large clients, and they don't yield good margins. So the idea was through FY25 and FY26, we would cut a lot of that scale of Acuity customers, which I'm happy to report also is something that we've executed fairly well on in FY25. From the time of our acquisition, that we had 850 plus customers. Now we are down to, as of March 31st, 2025, about 700 odd customers. Still some ways to go in FY26, but that's the vector that we have executed well on in FY25. So that's the strategic pillar number 2. Pillar number 1, take the platform from human-led to autonomous in some cases and tech-led in some cases. Pillar 2, get all the elements of the Acuity acquisition correct. Pillar 3, execute on this thesis of being number 1 or 2 or 3 in each of our 16 features, even as we are executing on building the platform. That requires us to establish leadership in each of the features and prove that leadership through analyst rankings. We are typically focused on class, Black Book, Everest, and Vetters. And so I think we've made significant progress along those lines in FY25, and I will talk to that third pillar. The fourth pillar, obviously, is the growth strategy. On the growth strategy, I just want to clarify, there are essentially 3 market segments that we are operating in. Large health systems, mid-sized health systems, and independent physician groups that could be private equity owned or sometimes they're public companies as well. And in those 3, we have a differentiated go-to-market strategy. Large health systems, the buying behavior is still very, very rigid on point solutions. So there are strategies, we will continue to orchestrate a land and expand strategy. We will establish leadership in our features and sell those features as a point of entry to those large health systems and then expand from that. In mid-sized health systems, I think we're already starting to see a graduation from point solution buying to platform buying. So there our strategy will be, go-to-market will be much more platform-oriented. And then very interestingly, in the PE-led platforms or even publicly traded platforms, we're starting to see more and more appetite for the platform buying. So just keep this in mind, 2 of the 3 market segments, mid-sized health systems and independent physician groups, we will see more and more of a platform-driven go-to-market. In large health systems, we'll still have a more land and expand type of strategy. That's our 4th key strategic pillar, which is our growth strategy. And the 5th one is that slowly but surely, we will continue to move more and more to an outcome company. Now, this is a really important area because most of the healthcare IT ecosystem that exists in the US has been in the world of giving you a piece of technology and leave you with the challenge of figuring out how to deliver economic or clinical value from it. We believe that one of our moats going forward, based on the history of our company over the last 18 years and the genetics that we have built, with a little bit of fine-tuning, we will be able to be in the business of taking more and more accountability for driving outcomes from our platform rather than just providing them the widgets. And that is a gene pool that we are now starting to own and build, and that becomes the 5th key strategic pillar of our execution approach. And so what I wanted to lay this out for you all, because every earnings call, I will now refer to these 5 pillars of execution so so that we can relate to them and understand what is working. And if we have to pivot on any of them, we will talk about that. So with that said, let me just quickly talk about our execution across these 5 pillars and put it in the context of numbers very quickly. First, of course, let's just go to our feature cluster platform view. And I'm happy to note that we've actually made significant progress in that transformation from both human-led to tech-led, but in some cases tech-led to autonomous Gen AI enabled. If you look at the chart that Saransh is flashing, you'll see Scribble is now, we have a variant of Scribble called Scribble Now, which is a fully autonomous ambient listening scribble technology built on a GPT-4 and in the market now. With Scribble Now, we now have the most comprehensive range of clinical documentation solutions for physicians in the US, meeting physicians where they are in their journey of using clinical documentation, all the way from transcription, dictation-oriented transcription solutions to fully autonomous ambient listening technology. We've also made significant Gen AI-enabled progress in our coding feature, which is a very large feature in our platform. We already have the autonomous coding piece figured out for at least 2 very significant specialties, medical specialties, and we'll continue to progress that rapidly, having figured out how that technology works and having the access to mature that technology based on all the data in our install base. So, significant progress towards autonomy in coding. Massive progress towards autonomy in another very important feature, which is patient credential clearance, which is essentially built around prior authorization. Many of you must have heard prior authorization for care that patients need. Very big challenge in the US. Often lack of prior authorization leads to care not being allowed for patients. Critical care not being allowed in some cases for patients. And so it's a huge burden for physicians to prove that the care that they are about to provide to the patients or recommend to the patients is actually needed for their condition. So we've actually built a very exciting autonomous technology called Eve that actually addresses that problem. And then there's perspective in several features of our revenue cycle feature cluster within our platform, where a lot of progress has been made in the denial prediction and prevention dimension, because revenue cycle is garbage in, garbage out. The more you prevent at the front end, the less work you have to do at the back end. And our denial prevention strategy is a very, very important part of that. And then, of course, we've also been able to make some progress from a technology perspective and a Gen AI perspective in predicting patient behavior and differentially nudging patients both to improve clinical outcomes and financial outcomes. So that's been some of the progress on that key vector of moving from human-led to both tech-led and autonomous enabled through Gen AI. What does this do for us? It does 3 things. It fundamentally improves the scalability of our solution. It improves the velocity at which we would scale. Because imagine like a deal like, a platform deal that we would do in a pure human-oriented model, it might take us 6 months to implement the platform. In an AI-oriented model, we might be able to implement the platform in 3 months across all the features. So scalability, velocity, and then of course, margins continue to improve as a result of more and more tech deployment. So tremendous progress in that strategic vector. I will talk about our progress in strategic vector more in the context of our actual financial numbers. So let me now provide a high-level overview of our financial performance for fiscal quarter 4 for fiscal year FY25. I have to say that I think we've had a tremendous performance quarter that gives us a lot of excitement going into the future. For fiscal quarter 4, we're happy to report a 17% year-on-year growth in revenue, coming in at about 724 crore rupees. In addition to this performance, it's important to note that this 17% growth is in spite of the headwind of cutting the acuity customer base. Remember, we did 850 total customers to now 700 odd. Also, it also withstands the loss in revenue per customer that happens as we transform the acuity margins. Because obviously we incentivize customers to transform the model from a pure US-based tech model supplemented by offshore human capital in India. So in spite of those headwinds in revenue, 17% year-on-year revenue growth, due to tremendous execution on margins, our EBITDA came at 226 crores, right, which represents a 68% year-on-year growth from Q4 of FY24. So tremendous execution on the margins. I will say, and Nitya will perhaps provide a bit more details if needed, there were some one-offs in the FY Q4/24 numbers that were deflating the margins. So that has partly contributed to the 68%, but irrespective of very tremendous growth. And then, of course, that's resulted in a massive PAT growth of about 133%. So tremendous execution across the top line and the bottom line in Q4, leading to a successful quarter. EBITDA margins have gone from the 24% pro forma that we had in FY24 to now Q4 FY25 has come in at little north of 31% EBITDA. So I think that's been a tremendous progress in this quarter as well, and we stay on track for margin optimization endeavors that we had spoken about when we started introducing the business to you. So this starts to speak to that second vector, which is the Acuity acquisition, right? The second strategic vector. We're fully integrated as we talk on Acuity. The margin optimization is in full flow, which has led to this 31% plus EBITDA in FY25 Q4. And of course, there's a little bit more to come in FY26. I will talk about the cross-sell. I'm happy to report that we've been able to cross-sell features of the IKS platform to 4 significantly large health system customers in the Acuity install base. We're not at liberty to reveal their names, but super excited to see that early green shoots of cross-sell play out. And then I already said the right sizing of their customers has happened from, went from total customer base of 850 to 700. So that second strategic vector is execution strongly reflected in our numbers. One other thing I want to say about our Q4 numbers is, I said this on our last call as well, in our business, due to quarterly seasonality, typically it's not necessarily a good idea to look at Q-on-Q growth. But I realize that you guys are used to looking at Q-on-Q growth in addition to year-on-year growth. So we put those numbers here as well. If you look at the graphs, quickly. And the Q-on-Q growth on constant, on a consecutive quarter basis for FY25 is 10% Q-on-Q on revenue, nearly 13% Q-on-Q on EBITDA, and 40% the customer's life is essentially being enabled with strong transformation of margins in the legacy Acuity customer base, but then also some tremendous customer additions that we've had that we are happy to announce. And I'll put them in perspective of our market segments. The first one I'd like to talk about is Skylake. This falls into that mid-size health system marketplace. When I spoke about our growth strategy pillar, I spoke about the market segments and I said mid-size health systems. Mid-size health systems are showing more and more of a proclivity to the platform construct. And so happy to report that Skylake has actually committed to the entire IKS Care Enablement platform for their employed physician base. Super exciting. It's a mid-size system in the Pacific Northwest. Our definition of a mid-size health system is one that has revenues south of about $1 billion. So at $250, $300 million to $1 billion health system range is how we think about these mid-size health systems. What's also exciting about Skylake is, if you remember, we have 16 features that enable the physician business, but we were also being pulled by the health system, the hospital ownership for these physician businesses in the market segment of the health system, saying, why don't you apply the same core versus shore discipline to our hospital business as well? And we were just sort of dabbling in it, but the way IKS typically works is when we want to really launch in a particular space, we like to take on ownership of the function end to end. So in Skylake, what makes it super exciting is they've also given us ownership of their entire hospital revenue cycle. Now you'll see that in the hospital RCM space, there are many vendors that do point solutions even within RCM, where they'll just be doing AR follow-up or patient AR. We have responsibility for their entire hospital rev cycle in addition to the manifest to the full care enablement platform in their employees' position base. Important to note that if they're able to manifest and grow this business effectively in the hospital RCM space, that actually expands that $225 billion TAM by another maybe $50 billion, which is the hospital RCM TAM. So super excited about Starlink. Reflects that strategy that we have around mid-sized health systems' proclivity to buy more and more of platform deals. Second exciting deal, Western Washington Medical Group. Already an RCM customer of ours, independent medical group in the Pacific Northwest, also has embraced the full manifest of the IKS Care Enablement Platform. Again, right in sync with our strategy, two segments of the market showing proclivity to platform constructs, mid-sized health systems, and independent medical groups. They could be private equity owned, they could be publicly traded. Western Washington, fine example of that. Third, super exciting win, Platinum Derm, another private equity owned dermatology platform, maybe the number 2 largest platform for dermatology in America. Also was an RCM customer originally, and now they've embraced the full breadth of the IKS platform that will be implemented there. A very important win also, Ortho New York, that really starts to put us in the orthopedic specialty, which is also going through massive consolidation, and they've embraced our revenue cycle platform and are also doing some innovative things with us in the patient engagement hub feature of our platform. And then last but not the least, a massive win for us with GI Alliance. This is a $2.5 billion plus company that employs 1,000 plus digestive health physicians. Again, $2.5 billion plus in revenue, the world's largest digestive health physician roll-up. They were recently acquired by Cardinal Health, which is a Fortune 50 company, for a cash consideration of nearly $3.9 billion. With that acquisition, Cardinal has also announced that they will be expanding GI Alliance's capabilities into other specialties like urology. And, the idea there really is for us to become the de facto RCM execution platform for all of their endeavors across all of their specialties. So really, really marquee and exciting set of wins that again talk to the strategy that we have for growth, where mid-sized systems and independent groups are showing more and more proclivity to buy platform. Large health systems still continue to show more point solution behavior, which is why I'm also happy to report, like I was saying earlier, that 4 of our customer wins have been really be able to cross-sell our IKS platform to 4 of the acuity customers. Last but not the least in my remarks is if you go to the execution that we're having around being a leader in each of the features versus building the whole platform. And that really happy to announce that Black Book has recognized us. I'll give you the next slide. Black Book has recognized us as the number 1 player in AI-driven RCM solutions, clinical documentation, and medical coding. And then, in addition to that, KLAS continues to recognize us as the number 1 player in transcription. But they've also indicated that they will collapse all of the variants of critical documentation into one category. And if they did that, I think we emerge naturally as one of the leaders in that space. And then, of course, from a hygiene perspective, we continue to advance all our security-related controls through the high-trust R2 certification. So all in all, a very, very exciting and successful execution quarter that I think encapsulates all the hard work that the teams have been doing. At a very high level, I will touch upon FY25 before I get over to Nitya. FY25, if you could go to that slide for FY25, a year of strong execution, 47% year-on-year growth in revenue that has led to nearly a 50% year-on-year growth in EBITDA. Revenue came in at 2,664 crores, resulting in a 791 crore EBITDA that then created a 486 crore PAT, which was a nearly 31.2% year-on-year growth for FY25. Obviously, the PAT growth is a little muted relative to the EBITDA growth because of 2 reasons. One is the interest that came on the debt that we had taken on to acquire Acuity, and second is the amortization of the intangible assets that came with the Acuity transaction. So, again, to sum it up, strong quarter of execution, FY25 Q4, resulting in a pretty strong year. Good execution across each of those 5 strategic pillars that we will keep talking about. With that, I will turn it over to Nitya. I have one other remark to make after Nitya finishes, right at the end, but with that, Nitya, over to you.
Thank you, Sachin. Saransh, if we can flash slide 15.
Yeah.
So we have, I think Sachin's provided you enough color on revenue, so I'll talk a little bit about the expenses. If you look at, I'll start with Q4 commentary and then give you a bit more color on the full year as well. If you look at employee benefit expenses, which tends to be our largest expense item, you will actually realize that we have been able to reduce that significantly both year-on-year as well as quarter-on-quarter. If you compare it to Q3, this number was 57.3% as a percentage of revenue. From there, we have been able to bring it down to 51.8%. And if we compare it to Q4 of last year, that number was 60.8%. We have actually been able to grow revenues despite the reduction in headcount. Headcount, you will note that we were at 13,241 at the end of last year. From there, in Q4FY25, we ended the year at 12,661. If you look at adjusted EBITDA, which excludes ESOP cost, that's still at 32.8% for the quarter. EBITDA, as Sachin had mentioned, stood at 31.2% compared to 30.5% in Q3, a 70 basis margin expansion. And if you compare it to Q4 of last year, that number was 21.7%. So significant expansion compared to last year. It's been driven by 2-3 different factors. One was, of course, there was a little bit of a one-off in the base, which was towards the integration and acquisition costs when we were acquiring equity last year. But even excluding for that, margins have expanded very significantly, driven by one, realization of cost synergies in the administrative expenses, but more importantly, the transformation of equity's business model, where we have been able to do both a combination of deployment of IKS's tech as well as changing the mix from onshore to offshore. And of course, there's been a ramp up of the new customers as well. Looking at finance costs, we had about 20 crores of finance costs in the quarter, and D&A was at 28 crores. Year on year, you'll actually see a meaningful reduction in finance costs, and that has been driven by our strong cash generation and therefore our ability to pay down debt. If you look at ETR for the quarter, it was about 18%, but for the full year, it was about 19%. This took PAT to 148 crores or 20.4% in terms of margins. The ETR for the full year, as I mentioned before, was 19%, but please expect ETR for the next year to be around 21 to 22%, because we will be using some tax breaks on one of our equity units. A bit more commentary on the full year numbers. The full year revenue growth, as you will note, is 46.5%, but do remember that the base FY24 includes 5 months of equity. We ended the year with an EBITDA of 29.7%. And you will note that the pro forma EBITDA of IKS and equity combined for 12 months in FY24 was 24%. So a significant margin expansion compared to FY24. Finance cost has increased to 89 crores to the full year, but this is due to the full year impact of the debts that we had assumed when we acquired equity. Full year PAT was 18.2% as against the 20.4% last year. Please note that the pro forma PAT was actually 12%. So again, comparing like to like, PAT has also expanded quite significantly. Saransh, if you can go to the cash flow slide. So our cash flow remains very, very healthy. If you look at the operating cash flow, we ended the year at 434 crores. If you look at free cash flow, it ended at 275 crores, both of which represent very, very strong growth year on year. This is despite a 139 crore performance guarantee that we had extended to Palomar Health, one of our marquee clients. We had discussed this with you in the last call. If you look at a net debt position, again, we have been able to pare it down quite significantly. If you look at FY24, we ended the year at 850 crores. From there, we have been able to bring it down to 560 crores. Again, despite the performance guarantee we have extended. If you can go back one slide up. So EPS for the full year was 29 rupees, and return on equity remains healthy at 27.2%. The gap between FY24 and FY20 is 25 is largely explained by the fact that some of our strategic investments were revalued at a higher number. Therefore, the equity expanded without any commensurate expansion in profits. I will stop my remarks here and hand it over to Sachin.
Thank you, Nitya. Appreciate all the details. So as you saw, a really strong quarter of execution and really a strong fiscal year of execution that has now resulted in us being one platform that is ready to execute in this mission of creating pretty much what is a new market. And so I need to move to slide 5 for my last set of comments. I want to end with saying that it's really important to also recognize what's happening in the market. In addition to talking through the numbers, my other two objectives from this call was to lay out the 5 pillars of our execution strategy for you so that we can continue to refer to those pillars and build a consistency in our dialogue. And the second was this whole conversation around making sure we calibrate on what's happening in our market from a competitive perspective. Just to put it in perspective, there's been $45 billion of equity investment from 2021 to 2024 in this larger healthcare IT landscape, this $222 billion TAM, or now the $275 billion TAM with acute RCM coming in, as well as the $35 to $40 billion TAM that's already outsourced, that's growing at 12%. Important to note, what are the key characteristics of this investment of $45 billion? Most of it has gone towards what I call point solution companies. A lot of it specifically within point solutions, revenue cycle point solutions. So whether you look at the big boy R1 that was taken private from being public by CDNR and TravelBook for a valuation of $9 billion, even when they were barely making any net income, $3 million net income. Or when you look at some of the marquee private equity arms, Indian arms of marquee global private equity firms investing in more India-based task RCM vendors that are trying to graduate and go upstream in working directly with healthcare providers in the U.S. For example, the GEBs, the Accesses, and the Infinixes of the world, or the AGSs of the world. Or then you start looking at the U.S.-based venture capital type leading players, like you start to think about the money raised by Bridge, which, as you know, is actually one of our strategic investments as well. And we had invested just about 18 months ago, perhaps, at a pre-money valuation of nearly $100 million, and they just raised $400 million at a valuation of $2.75 billion. So within 18 months, the valuation has gone from $100 million to $2.75 billion. Of course, they don't yet make money, and they're predominantly a point solution vendor, specifically in the ambient GenAI clinical documentation space, or Suki, for that matter, where Zoom made a strategic investment, and they're also a point solution for clinical documentation, or for that matter, in Innovator, where they recently raised a big chunk of capital at a valuation of $2.5 billion. All this to say that there's a lot of investment happening in this space, and in my mind, that investment signals 3 things. First, it is an imminent recognition of the massive opportunity in this space. So that is really, really important. The type of players that are investing and the quantum of capital that is being invested is massive. Second, naturally, that's going to create competitive intensity. And so, yes, we should expect significant competitive intensity backed by large pools of capital in these spaces. But what's exciting for us is really, if you think about it, most of these companies are still very point solution oriented. Especially after some of our wins of this quarter and last quarter, we feel like our strategy of where there will be recognition by the buyers of the value of the whole being greater than the sum of the individual parts, and the graduation towards a platform approach, I think is going to be a very, very important cornerstone of our strategy. And hopefully, if we can translate that to also really making sure we deliver outcomes from the platform, it starts to create a moat that, in spite of all this capital going into these point solution companies, we will be able to withstand the competitive intensity that is coming our way without compromising margins. And then last but not the least, humbly, I want us to think a little bit about the capital efficiency with which we are building the business. As you can see, so much capital is going into each of these point solution companies, and here we are building the full breadth of the platform, essentially through the internal accruals and the power of our own organic balance sheet. So, wanted to sort of bring that to sort of conclusion. In conclusion of my remarks, again, a strong quarter of execution. Hopefully, through this dialogue, we'll continue to calibrate more and more on our strategic execution pillars and continue to report our performance against them. One last remark, obviously, given that this is still a market that is being discovered at the platform level, I do want to highlight that, we're not yet in our market at the level of maturity where you can model out exactly what the growth curve will look like. And hence, I've humbly been saying, look, I believe we will grow faster than the TAM is growing. The TAM is growing, the outsourced TAM is growing at 12%. I do believe fundamentally, if you model us out in the long term, we will continue to grow faster than the 12%, and our earnings growth will continue to be faster than the revenue growth. But it's impossible for me to provide any guidance as it relates to what will happen next quarter and next quarter after that. So I know many of you are anxious for that. Many of you are wondering if it was 225 crores of EBITDA in Q4 FY25, how much can we lock in from that for FY26? I just want to highlight that it's not a mature enough market where I can give you that type of guidance, which is why I will continue to refrain from giving guidance about future performance. And if you could please keep that in mind as you ask questions. With that, thank you for your time and attention. I will turn it back to the operator for questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ruchi Mukhija from ICICI Securities Limited. Please go ahead. Ruchi, if you can please unmute your line and ask your question. Since there is no response, we move on to our next question, which is from the line of Samir Shah from ValueQuest. Please go ahead.
Yeah, hi. Congrats, great numbers. First question is if you would like to address the United Healthcare news flow and the impact that it would have on our company. And second, these large deals that we have signed, typically, what is the kind of ramp up time that they would take?
Hi, Samir. Thank you for the question and your compliments. Appreciate it. First, United Healthcare. Look, guys, it's obviously a difficult time for them. They have been hammered with three macro issues that have hit them sort of back to back, right? One, of course, is the HCC version 28 that is compressing their margins on the Medicare Advantage contracts that they have, which is a big part of their business. Second, as you know, the CEO of their insurance business got assassinated just a few months ago. And third, they have this big security issue with Change Healthcare. So I will tell you that there are not many other companies in the world that can withstand three such back-to-back events that come at them in such dramatic fashion. Having said that, they are still the world's largest commercial health insurer. They, I think, have something like 60 million American lives insured, just to put that in perspective. And, the reality is IKS's relationship with United Healthcare is through Optum Health, which is about a $110 billion subsidiary of United Healthcare, which employs 50,000 plus physicians, the world's largest physician employer. And we obviously are building our care enablement platform for Optum Health. And remember, our care enablement platform works at the on the non-discretionary spend, on the OPEX. And so our platform is all about creating more financial value from the OPEX that they're already incurring. So if you look at what's happening with us over the last 18 months, where they've been hit by these three dramatic events, I think our business with Optum Health has grown at least 25-30%, if not more, over that duration. So without going into any speculative thinking about what might happen, the CEO has changed, look, the business isn't going anywhere. It's the world's largest commercial health insurer. It has too many lives that anything's going to go wrong. It's not like they don't make money anymore. They make money, but they make less money than they used to because of industry headwinds that they are facing. And so they're having a big valuation decline. And in a country like America, big valuation decline means, CEOs have to take the hit. And so that's really what is happening. Our relationship has only grown over this period, and we have no reason to believe, based on the nature of our relationship, that this headwinds that they are facing create anything but tailwinds for us. Now, again, I don't want to be speculative, but I will tell you that from everything I am able to see rationally, taking the emotion out, the Optum Health relationship looks very, very strong for us going forward. The second question you have, Sameer, is as it relates to the ramp-up of the new strategic customers that we have signed. I will say, Sameer, typically what happens is full platform execution takes somewhere between 4 to 7 months, give or take, depending on the size of the customer. And if it is one feature that we are implementing, typically that can come through in about 3 to 4 months. So that is the way to think about how these ramp-ups happen. And, obviously, depending on which feature it is, how much tech intervention there is or not, some of this timeline can be accelerated or not. But generally, those are sort of good benchmarks to keep in mind as it relates to ramp times due to implementations.
Super. Thanks. I'll join the queue.
Thank you.
Thank you. The next question comes from the line of Srivatsan Ramachandran from Avendus Spark. Please go ahead.
For two things. You mentioned about the changes that are happening in the industry with the amount of private equity capital and changes, right? This coupled with AI, how do you see? Because the biggest difference from a business model point of view has been the output-based pricing model you've had. Do you see customers or competition kind of changing this, offering other options which wherein the benefit of technology and technology improvement stays with the client and using this as a strategy? Any big market changes you change with because of these two changes that's happening in the market?
So thank you for your question. I appreciate it. Look, like I was saying, when there is this much capital being put behind point solutions, and there is a democratization and acceleration of the development cycles due to something like AI, obviously at a point solution level, the competitive intensity is going to go up. Which is why, if you remember, one of our key pillars of our strategy is that we want to continue to strive to be number 1 or 2 or 3 in each of our features, while we are the only company in the world building the full breadth of the platform. And I think that really is addressing that issue, right? The reality is that Gen AI is commoditizing the rapid advancement of these features is a reality. Our alpha from that perspective is deep customer relationships that give us access to data and context to mature the Gen AI faster than some of these new competitors, even no matter how much capital they have. That continues to be an advantage for us is the deep, like think about it, right now, GI Alliance, it's the world's largest installation of GI doctors by a long way. Like the number 2 player is probably not more than 300 or 350 doctors. These guys have more than 1,000 doctors. Now think about our ability to build the care enablement platform for GI better than no matter anybody else that comes in with large amounts of capital. We naturally have an advantage, whether it is at a feature level for GI specialty or at a platform level. So I think absolutely we should expect more competitive intensity. We should expect more players at a point solution level. Our strategy to win at the point solution level is the deep customer relationships we already have that allow us to mature the data. And our strategy, obviously, larger strategy to win against the point solution vendors is this whole graduation towards platform buying behavior. Having said that, I think we live in a very, very disruptive world. And so one of our biggest opportunities is to stay extremely alert from a competitive perspective and track the implications of competition in the marketplace day to day.
Sure, thanks. I just have one quick question. The runoff of revenues on the equity revenue, we have more or less done close to the bottom of it. I just want to get your thoughts.
No, like I said, when I was articulating the sub-vectors of that equity strategic pillar, that tail cutting will continue through FY25 and the larger part of FY26. And so it is not done yet, and we will see, because remember I said that we went from 850 total customers to 700. Our end objective is to be ending up somewhere between the 550 to 600 range. And so there's still some work to be done, and there's still some customers left to be transformed from a US-based headcount operating model to a tech-led offshore headcount enabled model.
Sure. Thank you. I'll come back later.
Thank you.
The next question comes from the line of Nilesh Jain from Astute Investment Management. Please go ahead.
Hi, thank you for the opportunity. Great set of numbers. My first question is, I wanted to understand your strategy on your top 10 clients. If you look at your top 5 clients, they do average revenue of around $15 million. I want to understand the potential for those top 5 clients, and what is our strategy to further cross-sell or increase our wallet share there. And then on the next top 5 clients, wherein we do around $8 million average revenue. So how do we plan to grow these clients?
Okay, great. Thank you for the question, Nilesh. So the reality, Nilesh, if you see is when you take our top 5 clients or our top 10 clients, all of our top 10 clients have a wallet possibility of at least $100 million a year ACV with us, right? So for now, our top 10 clients today, we can say that we are anywhere close to the full wallet potential that they have. Our largest customer, the full wallet potential is north of $300 million. So the simple math, whether you look at top 5 or top 10, is to continue to manifest the land and expand play that we have with them. And the fact that the top 5 and the top 10 are growing is actually demonstrating the fact that that land and expand play is continuing to work out. Now, the other thing that's happening in that mix is we are now starting, because we are getting mid-sized customers and independent medical groups that are manifesting the full platform, that list of top 5 or top 10 is rapidly changing, and that's why you see some of those vintages of those customers changing in the deck, is that there are some new customers coming in with a full platform manifest that day one become a top 10. And so I think this top 5, top 10 is still a little bit immature. The way to think about it is we are nowhere close to full wallet share with any of our top 10 customers. Some we have more headroom, some we have lesser headroom, but there's headroom across all. And then the top 5, top 10 list, hopefully, if we execute well on our strategic vectors, is actually likely going to change over the next, say, 2-3 years, because if we keep landing more and more platform customers, they naturally graduate to that top 10 list faster than some of the other customers.
Okay. Given it's dynamic. If you acquire, you might, like last year you acquired Palomar type, deal. So that would change the top 10 clients. So given how should we look at the growth on that side for your top 10 clients, and then obviously on the rest of the clients, obviously depending how we cross sell them.
It's very hard for me to give you a way to truly model that. What I would model is every year 80% plus of our growth will come through expansion of existing customers, and under 20% will come through the addition of new customers. That I can tell you. But it's very hard for me right now in this relatively immature marketplace where there are so many dynamics, graduation from point solution behavior to platform behavior in certain market segments, full adoption of features by large health systems that we've traditionally not seen. It's very hard for me to give you how to model our top 5, top 10. I would just say 80% of every year's growth, 80% plus from existing customer expansion, and under 20% from new customer acquisition.
Okay. My second question is, we have seen a good amount of reduction in your employee count by almost 450 employees from your previous quarter. So what was driving this efficiency, and how do we see the employee count grow, for the next FY26?
So, Nilesh, the way to think about it is Nitya has this statistic. I'll ask her to tell the specifics of it, where for FY20 to 24, our revenue grew significantly faster than our headcount. That non-linearity demonstrates the power of our technology-led disruption. And there are two vectors in our technology-led disruption, where we go human-led to tech-led, which is incremental reduction of headcount for the same solution. And then there's human-led to fully autonomous, where the disruption of headcount is significant. And that is also being manifested predominantly in the Acuity customer base, where we've dramatically transformed the Acuity margins from where we had acquired them. So that's the way to think about it. We will continue to drive non-linearity. We have, remember now, I think about 460 odd technologists that are writing a lot of this proprietary technology. We have a GenAI Center of Excellence that is producing a lot of this technology. And so that trend is going to continue to happen. If you have that statistic. Yeah.
So the employee count reduction you're seeing, Nilesh, is predominantly driven by the fact that we've been able to deploy both IKS's technology as well as the transition between onshore and offshore. If you look at legacy IKS, what we have been able to demonstrate in the past is non-linearity between revenue and employee count growth. If you go back and look at FY20 through 24, our revenues grew about 25%, and in the same time frame, our employee count grew only 10%. So as we technology, and I think Sachin's mentioned several times before, it remains a very high priority for us, and we continue investing there. And therefore, we hope to do as much or better in terms of our ability to drive faster revenue growth with lower employee count growth in the future as well.
All right. Okay. Just now, a last question, a broader question on the industry. Like you mentioned, majority of the private equity players have been acquiring point solution-based companies and focusing on the RCM side. So, and these companies have not been able to make profit as IKS has been able to generate. So, what do you think? Why these companies have been able to have been facing such challenges? Given you are the leader, making top 30% margins, and they have been not able to even make double digits. What do you think is the challenge they are facing, and what we are not facing?
So, Nilesh, I will try to refrain from commenting on what they are not doing right. I can tell you what we are trying to do. And what we are trying to do is that IKS built a business model where our pricing was outcome-based, right? We get paid as a percentage of the customer's revenue. And so that, when you combine that with our ability, demonstrated ability to drive non-linearity by reducing the headcount required for a particular task at the unit task level, that naturally creates a margin accretive business model in which the customer certainly wins because we're actually collecting more and more for them, and we win because we are able to collect that at a lower cost. And since your question was RCM only, I'm focusing on that. So it's based on the inherent structure of the business model that we built from the get-go that perhaps we are able to drive margin superiority. And that is also one of the other reasons why I said that we will continue to make that outcomes orientation one of the 5 strategic pillars that we will execute on now, not just for RCM, but for the entire platform. Because I actually fundamentally believe when I talk to buyers across the country, I'm finding that there is a fatigue emerging in buyers of buying the next best AI point solution and then figuring out whether it delivers value or not. And if they find models where their outcomes are aligned to the vendor outcomes, I think there's a different level of proclivity to that construct. So again, I will refrain from commenting on sort of what they're not doing right because, I'm sure they're very smart companies and they'll figure it out. But my best guess is that the fundamental structure of our business model and our execution really around it is what has driven our margin superiority.
Okay. Thank you so much and all the best. I'll join back in the queue.
Thank you.
Thank you. The next question comes from the line of Seema Nayak from ICICI Securities Limited. Please go ahead.
My question is more towards the sector. So what percentage of our revenue is from Medicaid, and how does the reduction in the Medicaid spending impact the provider ecosystem?